Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to GetRetiredStayRetired.com. And now, here's Craig Bolanos.
Hey, good morning to you and a very happy Sunday, giving you those sincere and actionable ideas that you need to improve the lives of yourself and your loved ones financially. That's what we do every single week. You know, we said a couple of years ago, and here we are 2 years later, that there were more people retiring in America than have ever retired in the history of time. Let me say that again. We entered a period 2 years ago where over 10 years, more people would retire than have ever retired in the history of time. Yeah, let that wash over you. Think about the implications for the workforce. Think about the implications for Medicare, Social Security, all of these safety nets. Maybe, just maybe, with that many people retiring and that much intellectual capital retiring at the same time, maybe the intersection of that and artificial intelligence actually lines up perfect. But what do you need to be doing to future-proof yourself? That's not just getting retired, that's staying retired. That's investing and starting to invest in everything that artificial intelligence can't replace and everything that artificial intelligence can't reprice. So, David, you're on the front line. You work with clients all across the country. And what are the keys that people need to put in place to get retired? I think a lot of it is those three pillars of retirement income we discuss: capital matters, generating sufficient income, and having a plan to grow the capital balance in order to grow the income. But line it up. If someone comes into VestGen Wealth Partners and says, I'm within a year of retirement, walk us through what that journey looks like.
Yeah, well, I think everything starts with, well, what's their plan? Most families that we have a conversation with via Zoom call, a conference call, or we get the opportunity to meet them in person in the conference room, most families, I feel like, are directionally correct. They've done a good job saving. They're trying to be mindful of income taxes. Maybe they've already had the opportunity to put pen to paper and draft estate documents. But if there's one singular thing that I think a lot of folks are missing, is what I would just call a tangible retirement plan, where you might have the resources, but maybe not a very specific plan on how you're going to utilize those resources and replace a paycheck. And that's what we need, right? We need to set expectation, and you only want to retire once. And I think a big part of our job, Craig, quite frankly, is to actually set proper expectation. And a firm like ours that is primarily dealing with families either on the sprint towards retirement or maybe recently retired, we know what it takes to get it done for folks all across the country. And that's why when we meet people, and we've talked about this on the show before, Craig, sometimes just like looking at a simple calculator online that says, hey, everything's going to be fine. You know, like, what are the assumptions that they're using in those plans, right? How long are you going to live? What's the real inflation rate? So to me, it starts with the plan. And I just had a conversation with a family the other day. Planning today needs to be much more dynamic. There's plan A, B, and C, right? Because there's nothing better than when a family tells me, hey, I'll do whatever I need to do in order to make this thing work. But I think in today's environment, a lot of people feel like, hey, I'll work as long as I need to. But the question we have back to them is will your company allow you to do that, right? So you see that all the time. you're at the top end of the income spectrum, walk it through, right? We talk to a lot of people that are in that position.
All right, so let's break down everything that David said. If you're just joining us, we're talking about the fact that starting 2 years ago, we've entered a decade-long period of time where more people are retiring in America than have ever retired in the history of time. Later in the show, we're going to talk about investing in everything that AI can't replace and AI can't reprice. But when people come in a year in advance of wanting to retire, one of the things David just mentioned is people need a tangible retirement plan. David, what does a retirement plan from VestGen Wealth Partners look like as compared to what people are getting out on the street?
It comes in two parts. Part one is technology based, where we want to, what I call, stress test the game plan. And the stress test at the most basic level is assuming I live to a certain age with inflation at a certain rate, do I have enough money? Am I going to be okay? But we need to take it a step farther than that. And that's where we like to build out an actual cash flow plan that says year by year, this is when I'm going to turn on my Social Security. This is how we're handling Medicare. And this is how I'm going to cash flow it out of my portfolio.
So, David, what I'm hearing is it starts with the integration of technology, software, and discovery. And what you're doing is doing a goals-based plan to make sure we have critical mass, and you're making sure that you're doing multiple variations of stress testing. That's a combination of next generation Monte Carlo simulations, but next gen Monte Carlo simulations that include not just various investment returns over various holding periods, various inflation environments, various tax packages. That's the uniqueness of what we're doing that other people aren't. Then you move from there to the cash flow side, where you literally are creating a visual of from which accounts monies are going to come from, when money is going to come out of those different accounts at different periods of time, how that money is taxed, which then leads to a discussion of how to start investing. So bring in that next piece, investing after the planning purpose is done.
Someone asked me the other day, they said, do you believe in this concept that as we all get closer to retirement, that we should be getting more conservative? And I said, well, I can understand why someone would say that, but I think the reality is when we're creating plans at VestGen, the benchmark is what's the minimum rate of return you need to earn on a certain subset of money to get you retired and keep you retired. And oftentimes that doesn't mean that all of the money has to be invested the exact same way. So when we're using that methodology, right, I think that has to be the starting spot. I'm not a big believer that if you fill out, or answer 10 questions on a questionnaire, that's going to set the risk tolerance of your portfolio for the next 30 to 40 years of permanent unemployment. That retirement investment strategy is going to be based off exactly how much money is coming out of accounts and how much of a buffer we want to have for the next potential market drawdown that will eventually come, because it happens, 1 to 2 times every market cycle.
833-964-PLAN. That's 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Download any of our free publications, free education guides like the One Big Beautiful Bill Act for individual investors. You need to know what you can be doing to save money on your income taxes, and take advantage of a complimentary strategy session with myself, David, one of our team members that you can request between now and the end of the year, because we want to make sure 2026 gets off to a great start for you and your loved ones. David, we've been talking this morning about this tsunami of retiring Americans. And we talked a little bit about the planning discipline, which is that intersection of financial discovery, emotional discovery of what someone's going to retirement to, aligning it through a goals-based plan that is Monte Carlo simulated, but inclusive of tax analysis, moving into a cash flow strategy of where money is going to come from at different periods of time and from what accounts. But then talk a little bit about investing and talk a little bit about investing the VestGen Wealth Partners way, because I think that's different than what a lot of people are doing with simple blended portfolios.
I think a big part of us building portfolios is to create transparency so that the end investor knows what they own and how they're going to cash flow. So step one is we're going to line up your income so that you know how you're going to replace a paycheck for the next 3 to 5 years. And you should be able to see that on your statement. On the other side, right, if we're using like this barbell approach, what are we going to use to keep up with inflation? I think that's one of the largest challenges everybody is going to face moving forward. So we need to grow this capital still. And then we've got to find that happy medium of what I call like moderate growth. And maybe we can talk about this in our next segment, Craig. The reality with investing today is diversification is not just meaning having a whole bunch of different ticker symbols on your portfolio. Diversification moving forward is about correlation of assets. And I think one thing that's caught investors off guard is if they spread out these simple blended portfolios, they're starting to recognize a lot of these asset classes are moving in the same direction. If it's going up, that's great. But if everything's going down at the same time, we got a bigger problem. So maybe we cover that after the break.
I think that's a great segue. That's what we're going to talk about, is some investment ideas that you need to be thinking and how we're going to help you with the HELP acronym elevate your investment game going into year end 2025. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. You're listening to Craig and David Bolanos in the know, VestGen Wealth Partners on everyone's favorite station. I call it AM 560. You affectionately refer to it as The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560, The Answer. Welcome back. Here's more with Craig.
We're back in the know. Craig, before the break, we were talking about how we build retirement plans and then how we actually fill in the retirement investment strategies. And one of the things I had talked about is making sure that when you are building diversified portfolios, that diversification doesn't simply mean you have a lot of different ticker symbols on your statement. It means that you own asset classes that might move in different directions to build real diversification, not diversification from a name standpoint. Talk a little bit about that. Like, one of the examples I always think about is real estate. There, to me, is a difference between owning the hard asset real estate versus listed real estate. How do you view that?
David, that is absolutely brilliant. Listen, guys, part of this is a discussion of what we've been passionate about in the second half of the year, this idea of pragmatic optimism and diversifying your diversifiers. But David just mentioned real estate, and we want to help you. Yes, HELP. That's an acronym for hard assets. Hard asset base provides tangible foundations for enterprise value. That's the H in HELP. E, essential service. Essential service nature leads to relatively consistent demand profiles. That's a key in investing. L in the acronym HELP, long-term visibility, long-term cash flow visibility with contracted, regulated market or structural protections makes a heck of a lot of sense. And what's the P in HELP? It's a privileged position. It's privileged market position with hard to replicate assets, scale, or capability. So what I want you walking away from here on Sunday morning is we want to help you elevate your portfolio by thinking about investing in things that AI cannot replace and AI can't reprice. And that is one of the reasons you need to start putting some hard asset bases into your portfolio in those privileged positions that drive essential services and long-term cash flow. And David, real estate is one of those concepts, but there's so many forms of real estate. I think what you're hinting to, David, is maybe people shouldn't just buy shares of a real estate mutual fund. Maybe they shouldn't just buy shares of a real estate investment trust, because when those things are publicly traded, you end up with the publicly traded risk premium, which leads to an elevated price or at times an elevated discount. And something that everyone needs to pay attention to is what David said. You need to be diversified with a purpose. You need to have other things that can zag when other things zig. You need more non-correlated assets. And let's explore, David, some different areas of real estate that I think are incredibly exciting that people should be thinking about. And the first I mentioned is industrial warehousing. And you have to look. Everybody knows you're seeing big concrete bunkers. They're typically white or tan. They're concrete and they've got 80 garage doors and they're located off of major thoroughfares and major interchanges. And all you see are big semi trucks going in and out. And you know who those semi trucks are. It's the Amazons, the Walmarts, the Shopify's, the Grangers of the world. And it's handling what you and I would refer to as last mile delivery. And isn't it so incredibly interesting, David, that the best portfolios of those industrial warehouses now are even reconsidering how they're doing such things as AC, meaning heating, ventilation, and air conditioning. You're seeing new construction, David, where the HVAC isn't even on the roof of the building. The HVAC is located on the ground. And why is that? Because the tops of these buildings are actually being transformed, dare I say it, into hundreds of mini helipads, which represent the drones that are eventually going to handle the last mile delivery that goes by truck. It might be a boring investment, but investing in tangible hard assets, brick and mortar, with long-term contracts from a business model that is going ever present as you think about business to consumer, omni-channel. Everything gets delivered last mile by truck. In the future, it'll be last mile by truck, last mile by drone. And David, artificial intelligence supports that. Artificial intelligence can't replace that. Artificial intelligence won't reprice that because the demand is so large by consumers across the globe. That's why I think industrial warehousing needs to be on the list. David, we're talking about getting non-correlated assets, other forms of hard assets. I mentioned industrial real estate. Tee one up that you're working with clients that they should consider.
Sure. Another one correlated to AI would be data centers, right? That's what everybody wants to invest in. But if we think about that, let's break this down on a more granular level. You can buy publicly traded securities of stocks that are in the data center business. And we're not suggesting those are bad investments, but what we're talking about, right, is the hard asset. And let me give you an example, Craig. I think this is really interesting. I was reading an article over the weekend and it was highlighting two stocks this year. One was a real estate company. That real estate company had no dividend. It had no current renters and it had zero revenue. And the market cap of that company was $17 billion. Now, the reason that there was so much momentum is they have a contract to potentially build a data center somewhere in Texas. Likewise, there's another company out there, even larger, same thing, zero revenue year to date. If you combine the value of those companies, they're about the size of Ford, but Ford actually has $185 billion of revenue. So here's the deal. Sometimes when you have these hyped up market stories, you can get stocks to move, even when there's zero fundamentals behind it. That might be a great thing in the next 5 years, but really, would you buy a stock that doesn't have any revenue or any tenants or any dividend? What we're talking about are things that are actually hard. You can touch them, right? You can see the data center, you get dividend, it's tax efficient. And that's all I want to drive home is real diversification in portfolios is maybe not just getting on the hype train that something could happen. I'd rather buy something that's actually happening right now.
So let us help you use the HELP acronym to help your portfolio, because you want to get retired and stay retired. And that means you don't want to chase. So you need a hard asset base, a tangible value for that enterprise. You need an essential service, because that essential service nature leads to consistent demand. You need the L in HELP, long-term visibility. That's long-term cash flow with contracted, regulated market or structural protections. And don't forget the P. You want to be in a privileged position with your portfolio, and that's hard to replicate assets, scale, and capabilities. So think industrial warehousing, think data centers, think fiber optic networks, think cell towers, think all forms of energy production, because a 1 gig data center is basically the equivalent of 876,000 residential homes in the US in terms of power consumption. So that means one of these 10 gig data centers, a new hyperscale 10 gig data center, that's equivalent to powering 9 million single family homes. If anyone doesn't think the energy renaissance is real and power consumption is going to be so incredibly needed, you're missing the boat. And that's why we want you in some non-correlated hard assets. And that's why we're using the acronym HELP to help your portfolio results. David, what else do we need to know about this concept of hard asset investing, non-correlation?
Taxes. So one of the unique things about some of these investments is how they pass the dividend to you. Not in all cases, but in many cases, some of the dividends can be a little bit more tax efficient because they consider it a return of capital. So think of it as getting a more tax efficient dividend versus another asset category you can get. So as you were talking about before, Craig, when we build out retirement plans, we're running not just different inflation environments, but we're running what I would consider to be like current tax rates versus very punitive tax rates. And as we're building out these portfolios long term, asset placement becomes, or asset location becomes very important. Do we want to own some of these investments in IRAs? Or if they're passing through tax efficient income, wouldn't that be better to hold that in a non-qualified account like a trust and be able to generate higher income where we don't have to pay federal income taxes? That's the stuff that gets us excited as we're building out these plans.
So I want you to get excited. We want you to help yourself using that acronym of hard asset, essential service, long-term visibility, and a privileged position in your portfolio. If you want to learn more, you absolutely can. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. The name says it all. It's not an investment thing. It's not a planning thing. It's not a cash flow thing. It's not a tax thing. It's not a retiree healthcare thing. It's not an estate thing. It's not a long-term care thing. It's an everything thing. You and your family deserve a family office for regular folks. If you've got traditional values, you're comfortable, non-flashy, you're family-centric, and you just know that you need an elevated level of care, a higher level of advice, give us a call today, 833-964-PLAN. That's 833-964-PLAN. GetRetiredStayRetired.com. You're listening to Craig and David Bolanos. This is In the Know Radio on your favorite station, AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
In our A block today, we talked about the fact that there are more and more Americans retiring. In fact, there's more people retiring over the next 10 years, starting 2 years ago, than have ever retired in the history of time. As you let that wash over you, that means America's getting older. These age wave demographics, the baby boom population, the graying of America, maybe artificial intelligence is showing up just in time to help with all the intellectual capacity that's leaving the workforce. But so many companies are terminating, if not fully diluting, their retiree healthcare for those few companies who still have it from a corporation. And far too many companies are looking to get out of what's called the DB, defined benefit or pension plan game. And you too might be getting these updates or these offers to buy out your pension. And here are some of the key considerations that you need to think of when you're evaluating a pension as a monthly annuity amount versus a lump sum. David, how do you help families go through that irrevocable decision? It's a one-way door when people are thrust into the crux of needing to decide.
Education solves a lot of things. And at the end of the day, it's about putting all these options down on paper and really figuring out what works best for your situation, not just what your former colleague at work may have chosen to do for their family. But, as we're running these simulations and creating these cash flow plans, Craig, very real life example. A couple of weeks ago, I had met with some clients that have pension plans, and they were quite eager to roll them out to reinvest elsewhere. And I said, hey, look, before we do that, why don't we just model out option one, which is what you wanted to do, roll them out, reinvest in the capital markets, or option two, just keep them as kind of this boring monthly income. And when I was able to show them the numbers on their Monte Carlo and their stress test, they were quite caught off guard of how much their success rate, if you will, improved by having that monthly income. And we can talk all day about diversification between stocks and bonds and private investments, but we have to think about diversification from different sources of income. Social Security is one source of income. A pension source might be another source of income. And then you have portfolio income. And all of those are massive tools. So I would just caution people, don't be quick to just jump on that lump sum rollover. When we're stress testing portfolios, it really does create a little bit more certainty to have those monthly payouts if you're one of the few that are lucky enough to still have that traditional monthly pension payout. But the way you're going to make that decision is to literally spend the time to whiteboard it out. And if we're honest with ourselves, isn't that a good use of time, right? Like, we want to spend time walking through these different scenarios so that we've exhausted every opportunity possible.
The website is getretiredstayretired.com, getretiredstayretired.com, and read into that URL, read into what it means. You only got to get wealthy once. You only got to get financially secure once. And that means there's a tremendous reason why so many people should take a lump sum on a pension, but there's an equally good reason why so many people might want to take that monthly annuity stream from the pension company, or see if a monthly annuity stream from an outside insurance company can match or create an uplift. Because when you have substantial monthly income, it actually increases your risk budget, which is your capacity for risk, your capacity to pursue returns in other parts of your portfolio. And David, talk a little more about the next context. We were talking on break, we were going to discuss pensions, but you wanted to make sure we circle back to something else.
Yeah, I wanted to get back to the assumptions that we're using in these plans. Like, we've had a really good market run. I think third quarter is going to go down as one of the least volatile quarters we've ever had. So zero turbulence, as I like to say in the conference room. But when we're doing long-term planning, we can't use the expectation that the next 10 years is going to look exactly like the prior 10 years. And that has multiple implications. First, it has implications on the tax front. Very happy with where the marginal tax rates are today. Do I believe that they're going to be here forever? Probably not. So I think if we're being realistic, if you're running retirement plans, you need to run those retirement plans that your tax rates are going to be going up, right? I'd rather run it the most punitive way. And if it doesn't happen, great. But I just got a hunch that that's what's coming down the road. Number two, is it reasonable to say that the stock market's going to look like it did the last 15 years? Heck, we pumped in $6 to $8 trillion of stimulus during COVID. If you print money and give everybody a check, they're going to spend it in the stock market. If we don't do that same amount of stimulus, we might have a different environment. So let's plan that out, version 1, 2, and 3, and run these different scenarios. Because again, we have to think where we're going, not just what's happened in the past. And I think the other part too is, and Craig, maybe you can speak to this, folks that are very successful in their job, higher income, do very well. Everybody who's listening knows this. You might be the top performer, but companies don't have as much loyalty as they used to have. And what if you have that conversation with your superior who says, hey, look, you're doing a great job, but you're going to get replaced by someone who's 25 years old. You need to have that plan B already outlined just in case.
That's why we talk about having a set of goalposts. When you work with VestGen Wealth Partners, there's the ideal retirement date, right? Which is how soon can I retire? The problem is you might not have the ability to stay employed at your current capacity and current earnings rate all the way through. Because if you're listening, these reductions in force are nothing more than age-based discrimination in disguise. You see it all the time. Top performers, top achievers getting replaced and marginalized out of companies at critical periods between the ages of 55 and 65 years old, right when you're getting the kids off payroll, right when you're at a point of maximum savings. And that's why you need to do your retirement plan based on, hey, here's when I plan on retiring, but oh my heavens, what if I need to retire early because I'm getting ousted by my employer through a RIF? What if I need to retire early because I need to take care of an aging parent? What if I need to retire early because of this or that? And you got to bookend your retirement plans. And if you're a high income earner, you gosh darn better well have a really good strategy on how you're handling your employee stock purchase plans, your restricted stock units, your stock appreciation rights, your incentive stock options, your non-qualified deferred comp plan, your 83B elections. All of this is as much of a science as it is an art, because it is all about the art form of your 1040. How do you start merging and managing together retirement income with the intersection of your income taxes to start creating improved and defined outcomes? Just as people need to have a risk budget, which is not how they feel about investing, a risk budget is someone's capacity for risk. We derive those risk budget scores through our goals-based and cash flow modeling. You should have a marginal tax bracket goal. You should have a goal that your income falls within this bracket each year. You should have a goal of staying below the next set of means testing for IRMA, income-related monthly Medicare adjustment amounts. You should have a tax bracket goal so you too get the full SALT cap deduction if that's important to you of $40,000 versus $10,000. The OBA, the One Big Beautiful Bill Act, just brought in this enhanced senior deduction, $6,000 per person. That's $12,000 of tax deduction. That's like saying the first $1,000 a month you as a couple earn is now no longer taxed. Oh my heavens, but what are you doing to protect your OBA? It's all about engineering the income, and that's what we do at VestGen Wealth Partners. We help you engineer predefined, improved outcomes. So connect with us now, 833-964-PLAN, 833-964-PLAN. Go out to that website, getretiredstayretired.com. That's getretiredstayretired.com. More to come, AM 560.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
We We spent time giving everybody that acronym HELP, H-E-L-P, standing for hard assets, essential, all these different components. But when we talk about this thing of non-correlated assets, I mean, I was booked on TV multiple times this past week because once gold went above 4,000 an ounce, everyone's wondering if this yellow metal, this precious metal, was going to 5 or 6,000. Boy, I just saw B of A hike their price target for 2026 to over 5,000 an ounce. I saw Goldman come out saying gold will appreciate another 10% next year. That's another 10% in 2026. So what's driving this demand for gold? Where is all this money coming from? What is it about? Is it an inflation story? Is it a currency story? Is it a market uncertainty story? Is it a little bit of everything? What might it be? Let's break it down. So David has obviously been with me all morning. And David, when you think about real return investing, to many, they just focus on nominal returns. That is not what we do at VestGen Partners. We focus on real returns. That is the return on your money after the inflation effect. In fact, we go further. It's really a real return. That's the return on your money after the effect of inflation and income taxes. And David, we took those gold positions in global ETF portfolios. I'm very happy about that. And we're talking in 2026 about additional real return investing concepts with all of our clients. But how do you view precious metals and how do you explain that to a client in their portfolio? And then I'll spend some time as we banter back and forth talking about the underlying rally, the real reason for this move in gold.
Yeah, I mean, there's probably everyone has their own theory or theories as to what has propelled this huge move higher. But I think if we just use like one of the first reasons we allocated capital, which was last fall, we allocated capital to gold last fall because it was prior to the election and there was a lot of uncertainty. And historically, gold has been a great hedge for these uncertain times. Why did we double down on it in the spring? We doubled down on it in the spring because we started to see the value of the dollar decline, which is one of the other major moves with this precious metal. And it doesn't look like there's a catalyst to get that dollar to move higher. So I think it's really a confluence of a lot of things moving. But what I would say is it gets down to what we talked about before. We want something that's different than traditional stocks and bonds, which have had high correlation rates. We need something that's going to move in a different way. And we need something where there's only a certain amount. We have $37 trillion of debt. We can keep printing money. You can't keep printing new gold. You can't keep printing new cryptocurrencies in all scenarios. And I think that's where that demand is. So while we might not be advocating some of these asset classes for everybody, I think it's worth consideration because I think things have changed, certainly been spurned off by the tariffs as well. But I think it started with just major uncertainty. And now there's been some other driving forces, albeit a weaker dollar, that have added to this. And again, I think our view is we don't see that changing anytime soon. So perhaps, these all-time highs just mean we're going to get to even more new all-time highs through the remainder of this year and probably into 2026 as well.
So we're discussing gold and whether it has a place in your portfolio. And our view is gold is a bit like taking Tylenol. It's not going to cure any underlying disease, but it can definitely make you feel better and take the edge off. And I think the big story behind gold, as David hinted to, is gold is usually viewed as the storage of value. It's a flight to quality. It's an asset that investors around the globe flock to when economies get weak, when inflation might run high. Well, the U.S. economy is not weak today. The inflation rates come down tremendously. So what's driving the demand? One, I think it's the fact that we're cutting interest rates in the United States of America. I think we're going to get one more cut. That's going to happen this month, and we're going to get a follow-on act by December. In addition to those interest rate cuts coming down, it's weakening the value of the U.S. dollar that David alluded to. That's one of the reasons people are starting to look further at being global in their portfolio. But those lower rates and that weaker dollar in the U.S. have people saying, hey, maybe I don't want to just own treasury bonds. But I think the real reason for gold to be going up is I refer to it as de-dollarization. Yep, there you go. De-dollarization. I'm making up a word. I think it might be a real word. Someone get a thesaurus, a dictionary. Let's find out. But de-dollarization. And why is that? There are so many foreign countries that have always been U.S. dollar denominated in assets. And why not? Who wouldn't want to be dollar denominated in assets? I mean, the United States of America, we're exceptional. This thing of American exceptionalism, it's real. When the world gets rocky, people put their money into the US dollar. But what's happened this year is, courtesy of looking for fair and equitable trade, we now have tariffs. And as a result of those tariffs, we have a lot of financial power. We have a lot of financial influence. And you have all of these countries, especially in emerging markets, to a certain degree, Europe, who are finally saying to themselves, gee, if we have all of our country's reserves in dollar-denominated assets, then sanctions from the United States could be more crippling on us. And hence, you have central banks around the globe, investors around the globe, now not buying as many treasuries each month, no longer buying as many other forms of U.S. storage. They're just putting their money into gold. And I think that started with the Russians. There's a lot of reasons for that. Obviously, the Chinese are a follow-on act, and then you've got the rest of the emerging countries following suit. So therefore, maybe that trend is your friend.
So, Craig, we had a conversation several weeks ago when you were talking about, inflation and help and why we put this in. And you had said, look, like there is a chance, right, that we could actually have a spike in inflation, right, which could affect like the long-term bond market and stuff like that. I thought that was a really interesting way that you explained that. Can you share that concept of one of those other risks that's out there? Because it's another reason why someone might want to own gold. It's kind of complicated, but you do an awesome job of kind of breaking it down into simple terms.
Yeah, let's try to take a very complicated concept and make it simple for everybody. There's a conundrum that the Federal Reserve is in. David acknowledged the mass amount, the trillions of dollars of debt that the United States has. And how ironic is it, the irony that the Federal Reserve has cut interest rates, but mortgage rates are not falling as fast as people would anticipate. And even though there's not one, but two more anticipated rate cuts, follow-on acts in October and December, you're not seeing that 10-year Treasury yield come down. And it's that 10-year Treasury yield that really influences and controls mortgage rates. So I think the big scare that's out there, and why isn't the 10-year Treasury yield dropping in accordance with the interest rate cuts? Simple. Price and yield move in opposite directions. And if foreign central banks, no one's selling government bonds from the U.S., but if foreign central banks are no longer buying as many U.S. treasuries every single month at auction, that's going to keep the yield on the 10-year treasury a little bit higher. And if that yield on the 10-year treasury stays a little bit higher, one of the things you have to be thinking about is this: currency inflation. I mean, the U.S. dollar has declined 13% against the euro this year. That's just one example. You probably should have paid for your Viking River cruise in January, not today, because today is 13% more expensive. So I think the big risk that is out there is, while I'm not so much worried about the cost of goods sold, that CPI, Consumer Price Index, and PPI, Producer Price Index, I'm worried that with us getting a lot of goods and services from overseas, if the U.S. dollar continues to weaken, that means our dollar doesn't buy as many goods and services from overseas as it used to, and hence we experience currency inflation, and that's going to be felt by the end consumer. So how are you going to protect yourself from that currency inflation? You got to invest in other storages of value. That's precious metals. That's hard assets. That could even be digital currency. And if you want to learn more, you should. 833-964-PLAN. Get retired, stayretired.com.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
If you're listening to this show or you listen to this station, you are an information junkie. You want to learn. And hopefully this morning, you've got a little bit of a better understanding of how we put together retirement plans for folks that are on the cusp of or recently retired. There is no one-size-fits-all portfolio. There is no one-size-fits-all strategy. When we are building out these retirement plans, it is inclusive of your investments, your tax return, your estate plan, your retiree health care, and all of those workplace options that you've accrued over the last several decades. But if you're sitting there thinking, geez, I think I have all of the parts put together, I've got all the pieces, but I don't have a plan to create synergy amongst those different topics, then give us a call or go to our website, getretiredstayretired.com. Because if you're sitting there thinking, hey, I've got an investment person, or yeah, I use my TurboTax, or I have a CPA, or I have an attorney, but those people have never spoken to each other, and you feel like you're stuck in the middle, we're here this morning to tell you there's a different way to put it together. We built VestGen for one purpose, to create a family office for Main Street. What does that mean? In my language, it means a single source to go to have conversations about everything that affects your retirement. Investments alone, that's a commoditized business, but investments that are curated with your personal 1040, your estate plan, that's what we do. If you're ready to take your investment strategy and retirement plan to the next level, then give VestGen the opportunity to demonstrate what we put together, which is holistic financial plannings with investments that I believe are at the next level. If you're worried about inflation and you're trying to figure out how to recalibrate that portfolio going into 2026, and you want to implement these help acronyms that we talked about, go to our website, getretiredstayretired.com, download our OBBA guide, or better yet, take the time to sit down, have a cup of coffee, and get a second opinion. That's what we do at VestGen. We do it well, and we serve affluent families throughout the United States. You're listening to In the Know with Craig and David Bolanos. This is AM 560, The Answer.